Angel is brought to you by NetSuite from Oracle, the only system you need to run your business. Go to netsuite.com/angel to get your free guide called Crushing the 5 Barriers to Growth.
Hey, everybody. Welcome to Angel, the podcast. I'm your host, Jason Calacanis, and this is the podcast where we talk to investors, early stage investors. Now, some of them are running incubators like my guest today. Others are angel investors. Some have small angel funds, and some are even venture capitalists, but they all operate in what we would call early stage investing, which means day 0 to day 1,000. First 3 years of a company, as far as I'm concerned, is the early stage. Now, what do I do? As an angel investor, I invest in 30, 40 companies a year, and I do it with a fund and with jasonssyndicate.com, which if you're an accredited investor, you can go there and sign up. And you can see the angel investments I'm making and potentially join us as we invest in companies. It's a lot of fun. Read the book, angelthebook.com. It's a book I wrote about my experience investing in 150 companies, the lessons I learned, hitting 6 unicorns in 125 investments. Now, my guest today is Pete Flint, and he not only is an investor now with NFX and running an incubator that has just great buzz, and it's relatively new, but I met him when he was the CEO of Trulia, a unicorn. I believe you hit unicorn status, did you?
Or at least, yeah.
Yeah, which was sold to Zillow. Tremendous. Did Trulia go public and then got bought by Zillow?
Yeah. So we went public in 2012 and then acquired or merged, stock for stock merger with Zillow in 2015. For $3.5 billion.
Amazing. Congratulations. Yeah. And we met because we were both Sequoia CEOs. We met at some dinner sometime long ago. But I want to go a little further back. Normally on this program, we get right into angel investing, but I want to just get a little history from you because you also worked on a Web 1.0 company, which I was in love with when I was a journalist in the 90s called Lastminutecom.
Correct.
Am I correct?
Yeah.
Now, you weren't the founder of Last Minute. You joined the management team. What was your role at Lastminute.com?
So Lastminutecom, a fascinating Web 1.0
Explain
company.
the concept of this business and why it was such a juggernaut and so inspiring to people in the early days.
Yeah, so Lastminutecom started in 1998, 20 years ago this year in London.
Yep.
And the basic idea, which was like this empowering nature of the internet, was taking this unused inventory, whether that's flights, hotels, theater tickets, restaurant bookings that was essentially unsold at the last minute, putting that onto the internet, some opaque pricing, but certainly discounted pricing, enabling people to take advantage of these last minute breaks, last minute hotels, last minute flights. And it was, an iconic internet company at the time. So I used to work with Brent at a previous
he was the founder?
company. He was the founder, Brent Hoberman, Brent and Martha founded.
Wait, you worked at an internet company before that in 1998. What was that company?
So it was a small internet company. It was essentially a JV between British Telecom and News Corp or News International. So it's basically the access of trying to be the AOL of Europe.
Wow.
So it was basically the connectivity of British Telecom.
And this is what, 95, 96?
97. So it's like I graduated 97. It was my first job.
Incredible.
And
so you're right there at the dial-up stage of the internet.
Yeah, pretty much. So no, this was definitely. So and then the internet company before that, in 96 was a company called Delphi Creative, which was like this tiny internet studio. So literally this was like my foray into the internet was I took a job while I was at university at JP Morgan because I was like, I was like, do I want to become...
Where's Oxford or something?
Oxford, yeah.
So I could guess. So you know how I knew that? Your accent. And you're successful.
Okay, well...
Is that the number 1 school in the UK? Oxford?
I mean, Oxford and Cambridge are perceived to be...
Which one's better? In your opinion?
Oxford, definitely.
Of course. No, which one's harder to get into? Would it be like Harvard versus Stanford? Would that be a fair comparison? Cambridge versus Oxford?
I think they're a little bit like, I mean, it's like different things for different, different subjects. So like Oxford's good at some things and Imperial's very good for software and computer science. But anyway, for me, it was like, I went to get into the internet.
Yeah.
And I wrote to every internet company in 96, of which there were 32.
32 companies.
And one gave me a job, was Delphi. That kind of became line one. And then anyway, I met Brent at line one. And then when he started Last Minute in 98, I joined him as first employee.
It was such a great concept. I just loved it. Like, it was predating Groupon, which was like group buying.
Yeah.
But it became a phenomenon in Europe because I think young people would on a Thursday or Friday be like, let's go to Ibiza, let's go to Berlin for $100, for $50, for $25 a night, whatever.
It was, literally a phenomenon. So we started in 98, went public in March the 12th, 2000. And you'll remember that was the peak of the NASDAQ. So we raised like 200 million, like,
and literally 2 months later, the NASDAQ went from 5,000 to 1,500.
Oh, and it was like, literally the price of the peak, so it went down immediately. But it was like, I was in charge of growth. It wasn't called growth then, but it was like, that was my job.
Yeah.
And it was just a remarkable experience in terms of how to build an internet company. We did so many things right, so many things wrong.
Yeah.
And I think, as I think about kind of folks that I looked about now, it's people who have been in that kind of like, early hyper growth experience, not necessarily the founder, but kind of seen that experience was just like super, super valuable for me. So the company would raise a bunch of money in 2000, navigated the dot-com collapse, and then as a travel company that had the travel collapse that came after September 11th, acquired a bunch of businesses. I left in 2003.
Yep.
I had to move to the US, and then the company was acquired in 2005 for over $1 billion.
Wow.
By Travelocity Sega.
Yeah,
so
that travel
amazing.
space. So you went from the travel space into real estate. Mm-hmm. And Trulia was the business model. It was the most beautiful app in the real estate space. I always told you that. I thought you made the most beautiful one. And you were really early on the mobile tip. So I think you beat everybody to mobile.
Yeah.
And it was a lead gen business. That was the primary kind of use case.
Yeah.
So you printed money every time somebody went to look at a house. You got $25 or $50 from a broker who wanted the lead. That was the main business model?
So the original concept was that, so I didn't know anything about real estate, but I moved to the Bay Area in 2003, and soon after trying to find somewhere to live. And you
get a quick education.
You get a quick education. Then the only way to access information is via speaking to a real estate agent. And we all know we love to be kind of empowered and in the driver's seat. And I said, where is the app to help you kind of find this information? So the original premise was, how do we have the most comprehensive information about real estate combined with the most beautiful user experience to help people navigate.
And it was, still is probably.
And then we'd monetize through we could see all this like print advertising, which like billions in newspaper classifieds. That's clearly going to follow the audience. So that, it was kind of a simple kind of business idea back then, but that timing was kind of impeccable. That was the sort of like, the good fortune, plus a whole bunch of execution and growth and product innovation.
As investors, we like to ask the question, why now? You've learned this now because you're investing. What was the why now for Trulia? When you look back on it, what was the why now? Yeah. Why did that business work at that moment in time? So two things principally. So one was the availability of structured data or search capabilities. So we conceived of the business just around the time when Google was going public. Right.
And it was just like Google was this phenomenal ability to kind of aggregate and find unstructured data and essentially structure it. And so we built a vertical search engine essentially for real estate. And so that enabled, and plus the data feeds were coming out. So there was this availability of structured data. The other piece was the, post.com collapse, the massive availability of broadband.
Right.
And so
pictures.
Pictures and maps.
Right.
And so we were, it's remarkable to think, but we were pretty much the first real estate listing site with maps nationwide, which was and we turned a 1D experience into 2D and enabled people to navigate this. And so that was this is an amazing experience that you could previously stuff you'd go through newspapers or you go through
clipping stuff and making your own spreadsheet of where these locations were and
so that suddenly you had this breakthrough consumer experience both in user experience as well as in content. So that we started off, it's a marketplace business, so we started off on the consumer side as well as aggregating all this content. And so but the timing thing is interesting because we started in that time, so we launched at the perfect time. But then as you know, it's we launched at the peak of the housing market. So in the 2005, 2006 period, the house prices peaked, sales transaction peaked, and we were kind of since that point the transactions slid down.
Yeah.
So and then obviously in 2008 the housing collapse, which was precipitated by the financial collapse was precipitated by the housing collapse.
Yep.
Everything changed.
When you go through your second crash, what did you know from the first crash that informed how you should run Trulia? In other words, you watched Last Minute raise money right before, and if they hadn't raised that money, they would have been out of business for sure.
Yeah.
And then you watched them weather the storm, get through it, and get to $1 billion. So you must have said, hey, I'm a pilot, founders are pilots, who went through the turbulence, the worst you could go through, lightning storm turbulence, over the mountains, over the Rockies. What did you learn going into that, and how did you navigate it? Were you more calm, or is it still absolutely terrorizing? I don't mean to cause any PTSD here, by the way. I'm having a little bit myself. It looks like you got a little PTSD there.
We've all been through them. Like, every business is has its kind of crisis moment. So I think we had a culture of frugality from the beginning. And investing in real estate companies in 2006 was a bit like investing in, taxi or ride-sharing companies in 2009, 2010. It's like, it was extremely unsexy. So we'd raised some money, but we were incredibly frugal. I think there's sort of firstly you need to think about what is the long-term trajectory of this industry? And, it was pretty clear back in 2001 that people didn't want to fly near term. Yeah. People didn't want to go in hotels near term, but ultimately they are absolutely going to fly. They're absolutely going to stay in hotels. And so how do you take advantage of this opportunity? Let's not waste this opportunity. So the other piece. So
in every crisis, there is in fact an opportunity.
Oh, the great Churchill quote is seize the opportunity around the crisis. But that's hard to do because you are deer in headlights. I don't know whether you went to the Sequoia
Oh yeah, no, that was.
They were
rest in peace, good times. Buckle down, everybody.
It was a frightening time. So one is just having this sort of long-term view. Actually, this is a time to take market share if you have the capability to do that. The second critical thing is around culture, and I think that we had built a firm culture, a strong culture prior to that, and I think it's that trust in each other, it's trust in the kind of the leadership, trust in the model, the collective teamwork to navigate this stuff and do it together. Was that there's no way you can kind of get through this stuff without that culture and that team to do that. And those things, we'd kind of built that foundation from the beginning. There's a million kind of tactical things, but being thoughtful about timing, aggressive around market share, because we knew that analogy I was telling the troops back in 2008, 2009 was that the massive Web 1.0 travel companies, Expedia, PriceLineBooking.com, were built in the down market, 2001, 2002, 2003 timeframe. Everyone else kind of created, but they achieved scale. So what happened for us was that we kind of navigated this period, and we had to pivot, business model, a whole bunch of other things, and then came out incredibly strong. Yeah.
And both times you weathered an 80% decline in the market, which is, when you think of it, just unbelievable.
But it's that's a contrarian view of investing, right? Yeah. It's clearly the worst time or perceived to be the worst time to get involved in online real estate companies in 2009, or get in online travel companies in 2002. But looking back, it was absolutely the right time.
All right, when we get back from this quick break, we'll do a quick segue into your investing career after you've navigated successfully through two amazing exits with Trulia and Last Minute, and we'll talk about why you decided to go into investing and join and/or create. You created NFX, right? Or they recruited you?
A bit of both.
A bit of both. When we get back on Angel, the podcast. Okay, everybody, let's talk about something important. The top barriers to your growth, to the growth of your startup. Well, an Inc. 5000 survey tackled this very topic, the top barriers to growth. And here are those top barriers. Number one, it takes finance too long to close the books. We've all been there. Two, the company is too slow to launch new products. We've all been there as well. Three, hiring and keeping good people. We all know that's difficult. And number four, managing cash. Very hard. And number five, too many disconnected systems. We're all struggling through this. And finally, it's hard to get a full picture of your biz. Yes, that's what Inc. 5000 learned when they did their survey of the top barriers to growth. And because people have outgrown their business and financial management systems, they are facing these very 6 issues. That's why QuickBooks and spreadsheets might be fine to start, but eventually it starts taking 2, 3, 4 times as much work to get answers for your business. And those answers aren't always correct. They're outdated, they're incomplete. And you should know that the number one system for growing companies is NetSuite for Oracle. So when you outgrow all this QuickBooks and spreadsheets and disparate systems and you want to really get your company to the next level, you need NetSuite from Oracle. NetSuite is the one system that tracks and manages revenue, cash flow, HR, inventory, projects, and even e-commerce for every industry. Now you can run your business from a dashboard on your phone. That's why thousands of companies use NetSuite. It's the only system you need to run your business. So here's your call to action. Go to netsuite.com/angel, netsuite.com/angel, and get your free guide. And that guide is called Crushing the 5 Barriers to Growth. That's netsuite.com/angel. NetSuite, SUITE.com/angel. The only system you're going to need to run your business. Thank you so much to NetSuite from Oracle for partnering with us on Angel Season 2. Thanks again to the team at NetSuite. Okay, let's get back to this amazing episode. Welcome back to Angel, the podcast. You can visit us, angelpodcast.com, or you can search for Angel in your preferred podcasting app, whether that's Spotify, iTunes, Overcast. And when you type in Angel and you search for it, you will find a bunch of podcasts by religious people who believe that angels are among us. That's not what this podcast is about. This podcast is about angel investing. So you probably want to type Angel Calacanis. But we do get a lot of people, for the people who are listening right now who thought they were going to get a religious podcast, praise Jesus. I'm sending all the angels to you. My guest today is Pete Flint, and he is a serial entrepreneur who is now doing investing. About, I don't know, a year or two ago, I became aware of NFX. Mm-hmm. People kept saying NFX Guild. They kept saying there's an incubator or an accelerator or an fund. Clarify for us, what is NFX? Because I know you have 2 partners or 3 partners in this thing. And when I saw you go over there, I had heard the buzz about it, and I didn't know what it was. I didn't recognize the other partners, but I saw you go over there and said, hey, this must be legit.
Yeah.
What is NFX? Why did you join and/or found it?
Yeah. So NFX today, we're a $150 million seed fund. So we just announced our seed fund back a couple of months ago, end of November, early December, and our focus is investing in so-called network effect companies.
Okay, what does that mean? Define network effect companies.
So essentially a network effect company is one where with each additional user, it makes the product better for every other user. So the sort of classic examples we know are obviously Uber, Airbnb. In my domain, Lastminute is essentially a travel marketplace.
Yeah.
Trulia was essentially a real estate marketplace. We also think about platforms, data network effects, a whole bunch of different companies that sort of exhibit this property from B2B to B2C. So our thesis is to invest in network effect businesses. I'm so fortunate to work with 2 incredible partners. One is James Courier.
Yep.
James is based in Silicon Valley with me. He's got this amazing background, both an entrepreneur as well as an investor advisor. So he's founded a number of companies that have been very, very successful. He's an advisor, and he's sort of a growth whisperer to an amazing number of people, an investor in companies like Lyft and Poshmark and DoorDash and House and many others. And then Gigi Levi-Weiss is based in Israel, but he's back and forth couple of times a quarter.
So you're actively investing in Israel as well, or mostly U.S.?
Absolutely, yeah.
But those aren't network effect type companies. They're not known for marketplace. They're known more for enabling tech. Is that right?
There's certainly some truth in that. We have a very broad sort of aperture around like how we think about network effects. So let's take Waze, for instance. Waze, Israeli company.
Incredible.
But there's clearly a data network effect there. The more people use Waze, the better it gets. And every Uber or Lyft driver pretty much uses that.
Absolutely.
Right
I mean,
now.
if you think about network effects, one of the amazing things that people, I think, don't actually understand about a network effect is that every time somebody joins, it potentially makes every other person's use of that product considerably better. So the way to think about that is if you and I had a fax machine, we can each fax one person.
Yeah.
There's 2 connections, yours to me, mine to yours, but we had a third person. Now both you and I can hit that person up, and the fourth person comes in. Oh my God! All of a sudden, fax machines become valuable.
Yeah.
And certainly with Lyft, with the drivers, or Uber with drivers, Airbnb with hosts, you start adding more hosts. There's more transactions that can occur. There's more customers. More customers equals more money for those hosts, means they invest more money.
And ultimately what this provides is defensibility. So we've gone back and looked at all the billion-dollar plus companies over the since the origins of the internet, 20 plus years, and seen that 70% of the value that's being created by technology companies comes from companies that have a strong core network effect. So we know the names,
sure.
like whether
Google.
it's Facebook or Google, as ad network fundamentally where they're monetized. So like once you're like in and start and scale a network effect business, you realize there is no other type of businesses that's as interesting or as valuable as a network effect business. Ultimately, because they create winner take most or winner take all.
Yeah, winner take most seems to be what we're seeing these days. Usually there's like a duopoly or 3 people involved chopping it up. The first one gets 60, 70% like Facebook. Twitter and Snapchat get 10% each or something of social networks, and we're done.
I mean, it very much depends on the type of network effect. So we define 13 different types of network effect and built playbooks for each of them. So the tighter the sort of the more defensible the network effect is, the higher the market share. So let's just take ride sharing. So certainly in the Bay Area, it's a duopoly right now. And that's because there's an asymptotic network effect. As long as there's
asymptoting. Okay, hold on a second. I don't have a dictionary handy here. Emmy Warburg Jackie's going to put that definition. Explain to us what asymptotic means.
So asymptoting.
Asymptoting. I didn't go to Oxford. I'll be honest. You got to tell me. Define this word.
So essentially, what it means is that, like, you and I don't care as long as the pickup time is 3 minutes or less.
Commoditized, so commodity type business.
Well, there's a necessary scale, but then, the definition of a network effect is that as each incremental user makes it better for every other user, that is true up until a point.
Right.
And that point for most people is 3 minutes in the Bay Area. Whereas you think about something like Airbnb, that is a network effect business, but it's actually not. It's really become more, in many people's eyes, almost a monopoly for that type of inventory.
Sure.
Because of the lack of commoditization of that product and the lack of multi-tenanting often on the supply side. So we're incredibly deep in these type of network effect businesses, both as operators and as investors. And so, our view is that we think that this is the most interesting type of company to invest in, and we're kind of multi-category, multi-industry.
What about Amazon? This is one of the biggest companies. Mm-hmm. But they have a small percentage of overall commerce, a decent percentage of online commerce, but they certainly haven't been winner take all, but they've become huge. Is that a network effect business in your mind?
I think it's interesting.
The shopping side of it. Put aside Amazon Web Services, but the shopping, you and I buying.
So Amazon absolutely didn't start as a network effect business.
Right.
It started as its defensibility was principally through brand as a first mover advantage, through scale, through the distribution piece. But what they added on, during the kind of several years after their launch was the marketplace and network effect side of their business. And you think of, everything from the data network effects, from the recommendation engine and the reviews, down to the marketplace, where where
third parties can sell, right?
Third parties selling. And so the initial entry point was not a network effect business, and now they're scaled to become absolutely a network effect business. And their defensibilities are monstrous now, from scale to brand to embedding in all these systems, and then obviously network effect, which we think is the most interesting because it's frankly the cheapest to get going.
I wonder how you think about the data thesis of investing, like whoever has the most data, because network effect is something we've all been sort of watching over the last couple of years. Okay, we get it. Marketplaces, network effects is a good place to fish for startups and to build great businesses. But now we're having a whole group of people who are saying, it's the data. And in Amazon's case, they can study the data of what's being sold and say, you know what? We should make a camera bag. And so my camera bag's an Amazon camera bag, Amazon Basics.
Yeah.
And they've gone to, I think, something like 1,500 SKUs that are Amazon Basics now from just like 100, like the cable. So what do you think of data businesses like Facebook, putting aside their network effect, being potentially another thesis for investing.
So,
Do you look at that lens of the power of data?
For sure. So we look deeply at data network effects, and so
Data network effects. I like it, combining both.
Exactly. So there's data network effects. So I think there's a lot said about the incumbency advantage around data network effects in AI businesses. So how is it possible that you can never build a next generation kind of, let's say, travel company, because all Expedia and Booking.com have all this data. And I think the kind of interesting thing is some of this data is, as used the same language as before, is asymptoting, that you don't, just like in Yelp reviews, after the 50th review of a restaurant, I don't need the 51st, I've got a sense of it. So some of this data is asymptoting. The other piece is that the data is often not the right data to solve the problem. So take self-driving cars. It may be awesome that Tesla has all this data, but it doesn't have the LiDAR data around it. So there's the data network effects in self-driving cars, and the more data you have, the safer it is, the more distribution there is, hence the more data, but are you getting the right kind of data? So it's we're pretty sort of technical and kind of deep in this network effect, and we think that's, that our job is to spot network effect businesses before there's a true network opportunity, and also help them to scale that.
So why did you decide to stop being an entrepreneur and to start being an investor? I'm curious. People have different reasons to do this. You're rich. You got a lot of money, man. You took a company public. You don't need any more money, right? Why do this?
So, this. You've kind of been starting companies, you've been investing in companies. This is the greatest thrill you could possibly have while working. It's unfrigging believable. So I came out of 10 years at Trulia. And, I sort of forced, or maybe my wife forced me to take a year off and okay, let's just calm down. And
what was that year like for you?
Well, I had my second kid then. So I was changing diapers and
Lovely.
But what happened was I dropped my daughter for school and then meet with entrepreneurs, literally from kind of 10 to 5.
Incredible.
And it was, and I was sort of testing out this idea of being an investor. I spent a little bit of time at a sort of VC back in 2004.
Oh, it's like a venture partner or something, like loose affiliation?
Yeah, while I was at Stanford at grad school. So I was and it was it wasn't the right time for me then, but this was just the greatest impact you can have.
Were you part of the Sequoia Scouts program?
I was not, no.
You were not?
I kind of already had liquidity when they were
and you were I don't need to be part of that. Did they ask you? Did you pass?
They did ask me, but it wasn't I already had sort of...
So getting 100K or 50K or 25K from them to invest wasn't necessary?
I'd already taken Trulia public by that point, so it wasn't
So when you're meeting with all these founders and they're telling you, hey, here's how I'm going to change the world, and
so what I found, so I started angel investing, and it's incredible, and it's a number of very successful angel investments, as well as incredible fun dealing with entrepreneurs. But I actually found it quite unsatisfactory, in that it's I've found professionally that working with teams of smart people in solving massive problems is the most rewarding thing. And for me, teaming up with James and Gigi is just sort of incredibly valuable. It amplifies my good ideas. Yeah. It sort of it changes and sort of evolves my bad ideas. And it's just more fun working with other great people. So that was my kind of, I wanted to be part of a team sport as opposed to an individual. So Angel was good. It was a way to kind of test my learning on my own money. But I wanted to, what we think about what we're building right now is really much more of an institution. We're trying, how can we turn a kind of interest and experience in investing into a much bigger platform?
Speaking of platforms, I logged into something at NFX. It went into my Gmail and figured out who I knew and how many jumps I was from everybody. Yeah. And I was like, oh my God, I don't know if I want to do this, because it's going to result in my email box getting a lot of emails, but I'm in the business of getting emails. So what is this product that you created? Because I don't know if it's for me as in, super router angel, or if it's for new investors or it's for founders. What is this product called? And is it just a little experiment? Yeah,
so we launched a service. You're referring to Signal.
Signal.
So signal.nfx.com. So this is a product we've been working on for the last year or so, which is essentially solving the problem that you know very, very well, which is the warm introduction problem, which is like you probably, like me, get thousands of emails a year from entrepreneurs who are looking to get capital.
Yeah.
And having a warm introduction is the best way as a filter to say, well, that's kind of interesting. Okay, if this person thinks it's interesting, that's a great filter. And we were finding, and we built this product initially for ourselves. So with the problem, what we found was that kind of we were spent literally hours every day making warm introductions. So we built a software tool to solve that problem. So what it does is essentially like entrepreneurs and investors log in with their Gmail. It figures out kind of who they know and the strength of that connection, not just like...
Yeah, how many emails have we gone back and forth?
Yeah, we don't read the emails. We don't know kind of what they're talking about. We just like, and in the database, it figures out the sort of strength of connections between people to solve the problem. Like, oh, if you want to speak to Rolaf at Sequoia, well, is it like Pete or is it Jason who's the best person to make that introduction?
Right. Was he on your board?
He was not on my board.
Right, so he was on my board, exactly. So there you go.
But I know him. But you probably have a tight relationship with him. So
perhaps, yeah.
So that it figures out kind of who makes a warm introduction. So it's a software problem, a software tool that's solving this problem for entrepreneurs. So it's good for investors. It's good for entrepreneurs. And this is like, I mean, so why are we doing this? Like, why are we
building
software? So one is like we built it for ourselves, but it's a network effect business. It's a network effect product. So the more people that use it, the better it gets. So we open it up to everyone to get them to use it.
Yeah.
Two is that we are a collaborative investor. So we're like, we're a seed stage investors. Seed rounds are typically collaborative. You bring in other people and it's like, and so we wanted a tool that we could like figure out, okay, we can work with other people to navigate this. Three is like, in our heart, we're software entrepreneurs. We like building products.
You look at the world through a software lens.
Exactly. And if we see a problem, and this is more broadly, we look at venture capital, we think this is like kind of an antiquated industry in the same way that software is transforming everything else. We think that ultimately software will transform venture in a kind of meaningful way. It's not necessarily to replace, the general partner, although that, that may happen at some point.
Well, it might replace 20% or augment 20%. So you're really making partners bionic when you think about it. It's sort of like a cyborg kind of thing.
That's exactly how we think about it. Like, how can we, and it's also like, and we think about different levels. So we think about, one is like, we want to build software to help us become bionic and help us to be more successful. Two is we want to build software to help our portfolio companies to be better at what they do. Yeah. And that's beyond just a simple form. And three is like, unfortunately, we can only touch we can only touch 1% of the people that we want to work with. So how do we build software to help everyone?
It's interesting. We all come to it with what we know. You're as software people, you build software, and me as a media person, I build a podcast. Yeah. And write a book and have an event, right? Like it's like all of these things are potential ways to solve some of the same problems and getting to know people. What's the average check size that NFX likes to write? Is there an average check size?
Yeah. So we invest, I guess the sort of typical, we've been up and running for almost 6 months. So we've done about 8 transactions right now. They're all stealth. We haven't kind of announced anything right now, but like...
You've done 8 investments?
Yeah.
It's fascinating. I didn't get one email from you about any of these. Well, don't you want to have the world's greatest angel investor in any of these deals? I keep saying that. Someday it's going to be true. But what's the story here? How come I haven't got any emails yet?
So
you took the whole round?
No, we didn't take the whole round, but like we don't. You only reached out when the podcast, so we need to spend more time together.
Exactly. Well, this is the thing that angel investing really is about, is understanding each other and how you invest. It's one of the reasons I started this podcast is we understand what we're looking for and what target zones. Yeah. So what is a typical check size? Could you have $150 million fund, 500 to $1 million?
So the majority of deals we've done is $1 to $2 million.
Oh, okay. So this is serious check writing.
Yeah. And so our ownership, so it typically is $1 to $2 million, which has been the majority of the deals that we've done. So ownership is sort of 10 to 15%.
Right, because you're investing in companies with $6 to $12 million valuations, I would guess. 15 million.
That kind of neighborhood, yeah. So these are bigger seed rounds typically. Yeah. So we span from kind of pre-seed to A, but vast majority of stuff we've done is at the seed stage.
And interestingly, the seed stuff would have been the Series A when you and I were coming up.
Oh yeah, for sure.
$3 million round. Yeah. That was a Series A 10 years ago.
Yeah. The Trulia Series A was 2.4 million.
On a 10 million post.
Yeah, not even that. But
9
it's
million
like,
posts.
Oh yeah, around that figure.
Yeah, it would be like, it would have been like
Yeah.
for 20% of the company or 30% of
Exactly.
the company.
Yeah.
Now, Trulia would have gotten what?
I don't know.
For 20%
Probably like
of
what's a 90 million Series A?
There was one of those, wasn't
Oh
there?
yeah, the Aurora. Yeah,
It's crazy.
it's crazy. So I don't know, but
You
like
take a
this-
board seat because that's a pretty significant. If you own 10, 15%, do you think there should be boards? Are you pricing the rounds? Two questions.
So we certainly are pricing the rounds in the majority of cases, but not in all
Why
cases.
are you pricing the rounds? Explain to people why you think this is a good practice.
Well, I think it's what you see is that the overhang of the debt when companies are raising kind of multiple debt rounds, the overhang and complexity of that is bad from a dilution perspective from the entrepreneur, but creates a sort of ambiguity and lack of willingness to step up from an investor to say we're committed to this company. And so we've done a lot of, as a group, we've done 300 investments. So we have pretty high conviction when we want to invest. And so that means like, let's lead the round, let's price the round, let's make it.
So you lead and price and you say, hey, listen, we'll do this, but we want it to be a priced round.
Yep.
And do entrepreneurs fight you on that or no? They're just like, we're just happy to get you
No,
on
I
the
think they're
team.
like, there's a sense of like, I think pretty uniquely because the operational experience we kind of bring, they kind of like, okay, we want NFX on board to help us to scale this business. And then we act like board members and we set up board meetings and we are kind of incredibly engaged in the company.
Yeah.
We don't typically take board seats at the initial investment.
Got it.
Although as we kind of like either sort of scale our ownership and get to know each other, then we would head down that path. We sort of think board participation's a two-way street as well.
Yeah.
If we're adding value and they're adding, they're finding that, that the relationship is going well, then it will head in that natural direction.
Yeah. And you have a bunch of people who are unwilling to take board seats or unwilling to price these rounds. So I feel like it's creating a bit of chaos.
I think that was our observation. I
had a similar one. It's just chaos out there.
Yeah, but there needs to be someone to step up and say, like, okay, we're going to get behind this company. We're going to speak to the entrepreneur. We speak to the entrepreneurs typically weekly, where we're spending an hour, certainly the beginning of the relationship, an hour with the entrepreneur talking through everything. We help them set up board meetings. We give them kind of access to our broader community of founders to help to share different information, whole bunch of different content, which helps them to kind of ultimately have a fast start when they're getting going. We think there's a bunch of content out there which is available, but we talked about the sort of NFX Guild, the guild piece of NFX, essentially this community of founders which help each other. So so when you and I first met at Sequoia dinner was essentially like a private group of portfolio companies that is sharing the secret kind of tactics.
Yeah, and you and I were like talking SEO and mobile. And what about this new iPhone?
So the really cool stuff is
the App Store came out.
The really cool stuff is not published.
No.
But it's shared between portfolio companies. And so we try and facilitate that in a
It will
very,
be
very
published
active way.
typically 18 months after it's important.
Exactly, yeah.
So it's always trailing. By the time somebody writes it as a Medium post, that's like the 18th person to use the technique, which means the technique's probably been burned out by then, if you're getting it at that point.
Exactly. So it's like the bleeding edge stuff happens founder to founder. So we try and facilitate that.
What qualities do you personally, leaving aside your partners, but just you, look for in a founder? What do you think is important?
So three things. So one is persistence. This is Trulia took a decade from founding to exit.
Yeah.
Persistence. And we'd love to back kind of founders that become, that will be the CEO of the company through kind of beginnings.
How do you know if
to
the
exit.
founder is persistent when there's only 6 months or 18 months of data? Is it just a sense you get from talking to them that they're never going to give up?
I think so. Certainly, it's trying to look back in their past. What are the kind of how have they approached things? What are the adversities they face? How driven are they?
Yeah.
Truly driven.
Right.
To change the world, and and it's also about making sure that there's a passion to the problem that we're trying to solve.
So driven and passion, yeah.
But there's just persistence, and that can show up whether that's like they're a chess champion, or they're an athlete, or they're they've done something remarkable that gives them the persistence to go, or they've recorded 800 blog posts. Like there's a or a podcast. There's so certainly that persistence. Next, there's this, what is this unique insight around the market or unique technology capability, unique founder fit? There's often, to get, certainly in network effect businesses, there's like, how do you solve one side of the chicken and egg problem? How do you how do you get this thing going? How do you turn fuel into fire?
Right.
And what is that insight, that capability?
So that could be an idea, it could be an insight, it could just be some strength they have. Like they just know how to onboard drivers or get, it seems to me like the Airbnb people just really knew how to build a listing page. Like they knew to go take the photos, even though they didn't have a photographer. Like, we need better photos. Let's go take some photos.
And the sense that this is a, design-led. And PR, they were able to kind of the insight around that and scrappiness. And then the third piece is not just good at building product, but good at building company. And, there are so many founders that kind of hit a wall at a certain point, whether they then they don't want to scale or they can't scale, and just a thoughtfulness around company building. Because it's it doesn't matter how good your product is if you're not able to build an amazing company around that. Then you're ultimately not going to be successful. So
Reed Hastings comes to mind. They got the product right, but he just also seemed to be obsessed with the product that is Netflix. Who do you look at that you say, wow, that person is just obsessed with the product that is their company? You have a good example of that where you go, wow, this person really works on the features inside the company. Tony Hsieh from Zappos comes to mind too. He was a real culture obsessed person.
Yeah, I think one of the most exceptional kind of CEOs is obviously Jeff Weiner from LinkedIn.
Yes.
And I don't know the kind of inner workings, but my sense is that the kind of Reed is obviously a legendary product strategist.
Yes.
And the genius behind LinkedIn, Reed created the product. But Jeff created the company.
That's right.
And it's and the work that Jeff did behind the scenes to kind of evolve that into what it is today is kind of remarkable. Like in our, in kind of the, some of my angel investments that I've made. So there's former Trulia employees like Sammy, who co-founded Trulia with me. He's building an amazing culture within Virta Health, which is diabetes.
Oh, really? Is that one of NFX's or yours?
That's one of my angel investments. And
how is he taking on diabetes? Is he doing it with software or is he doing it with hardware?
So it's primarily software, but it's just the clinical trials around that, and diet and training and nutrition is
such a hard space. I just had a company called Open Listings on, which is trying to do the Redfin approach to real estate. Giving back some of the commission. And I was just thinking, God, people who go into healthcare, real estate, construction, or education, music, these categories they need technology so bad, but they just fight against it. Is it advisable to go into those categories, or do you look at them and say insurmountable? Obviously for real estate you didn't, but education, construction, music, you think too hard?
I mean, there are categories which are super hard. So clearly music and travel are kind of ones which are kind of pretty saturated at various different points, or have sort of challenges from the industry structure. I think what the high level view is, I use this phrase called the technology tsunami. So this sort of notion that you kind of see this unstoppable wave of technology coming in. And it's picked up the low-lying areas. So it's picked up media, communication, travel is being sort of transformed, and it's moving into higher ground, relentlessly. And so it is inevitable that it's now kind of transforming transportation. Obviously.
Yeah, that was a hard one. I remember introducing Uber to people, and there 19 out of 21 or 22 people, I think it was 3 people said yes, me, Cyan, and first round, and so everybody else was like, one person said, you want to be in that dirty business with those people? And I was like, kind of a little racist, but okay, what do you mean by those people? Cab drivers. These are just unintelligent foreigners. Your life is going to be dealing with cab drivers. And I was like, okay, that's slightly racist or kind of racist, but I understand you don't want to be in a business where there's a car accident. That was kind of their point. They're like, why don't we just make software? Is what they said. Why don't we just make software for cab companies?
But I think so clearly it's like massively changed in the last 6-7 years. So it's like, and then obviously in kind of real estate, which is a regulated industry, kind of a bunch of kind of fintech and regulation changes. But it's like you've seen in companies like WeWork,
right?
Or Zillow Group's now a $10 billion company,
Incredible.
And Airbnb is like it's changing the nature of space.
Yeah, hospitality, real estate, they're starting to flip.
Healthcare is
that's going to be the big
is
one.
Inevitable, and then in multiple different ways. So not just in terms of like building apps to help you kind of track your steps.
Yeah.
But it's
that would be the low hanging fruit. It's like just $99 Fitbit.
But it's we've invested in synthetic biology and CRISPR companies, and so what
are they doing? What category?
So it's in CRISPR specifically.
Yeah.
So it's interesting how you see these chemistry becomes digital.
Yeah.
And as we think about it at NFX, how you see these the techniques that are applied in the software era, which is principally network effects.
Yeah.
Are going to be applied also into the biology arena. So like
crazy
genetics and synthetic biology and
we're all going to have the
CRISPR.
same dog our whole lives, like Barbara Streisand. This should be like, before your dog dies, make another one.
Yeah, and agriculture. I'm an angel investor in Plenty, which raised hundreds of millions from SoftBank, and it's vertical farming and agriculture is another incredible.
So somewhere in a city there'll be eventually a 50-story building, like something out of Gattaca or some crazy sci-fi movie with vertical farms.
Well, this Plenty is it's exactly what they're doing, which is like turning, and they have, I forget the number, but it's on like 100 to 1 in terms of space efficiency and what they're
in terms of the acreage,
exactly,
because you've got vertical acreage.
Yeah, and it's a software company that happens to be in like.
Have they built units?
Yeah, they've built.
What's the tallest unit? How many floors?
I don't know
floors
exactly,
might be
but it's not. It's there's a sort of mid-size, but it's it's just the whole thing is that you're starting to use these software techniques, whether that's kind of machine learning, whether it's computer vision, whether that's kind of automated process, start to change all these different elements of our society.
Here's what I think is going to happen. All these garages, being a real estate person yourself, like they would force people to make a certain number of parking spots, like 1-to-1 or 1 per bedroom. It's crazy.
Yeah.
And so when we get to self-driving and car ownership in cities is like, you're going to be penalized for it big time. Like if you want to put a car in a city, already in London, the congestion tax, you get charged, what, 20 pounds to go into the city during?
Something crazy like that.
Might be 50 pounds. I don't know. It's absurd. Like only these jerk-off bankers do it in London. And we need that here in Soma. So all these internet people with their cars don't drive into like Second and Market. It's crazy. But we could reclaim these huge garages in the center of New York, in the center of Paris, in the center of San Francisco, and make them into farms or convert them into apartments.
Yeah.
We desperately need housing.
It's inevitable. I think.
Yeah.
I mean, like I have this. Some people have this sort of dystopian future of the dystopian view of the future, but I'm incredibly optimistic about our cities because you can start to see, like we were just talking about. I bike around the city these days, and
the jump bikes in San Francisco took over in a month.
I know, it's amazing, and
$2 a ride.
And so you can imagine a world where there's no sort of crazy drivers in the city. They're all kind of like pretty safe, tame computers that are driving around, and you get the sides of these streets are going to disappear, which are currently where parked cars are. I think it's a remarkable. And we're all going to live to 200 as well. So
I know Peter's working on it. We need to get a blood boy. Maybe we could split a blood boy because I can't afford a full blood boy, but we could split one. That would be a great time sharing a blood
You're
boy.
on your own there.
For people who don't know, there was this rumor that Peter was having transfusions. And then on Silicon Valley, they called it a blood boy, where the guy who's kind of the CEO of Google, which they call Huli on the Silicon Valley show, was getting transfusions from like a young athletic boy. But it seems like logical that we've already extended life far beyond what our genetics are supposed to do. They're going to figure this out. Unfortunately, I think we're going to miss it. I think we're going to get, what do you think? We get 10 extra years on average? Or our kids get 20? We get 5, our kids get 10?
I think it will. I mean, there's a sort of, I forget the term, but there's a kind of a point at which life expectancy increases faster than aging.
Right.
And it becomes a singularity sense.
And that's not us.
I actually think it might be.
Really?
We're in
our 40s.
Yeah.
Late 40s. You're 45?
40, thank you, 43.
Okay. I'm 47.
So like, so I actually think it will happen. I think, the
might
nature
be able
of,
to.
I mean, just this notion of kind of like, exponential thinking in the sense that you kind of like overestimate in the kind of near term, but underestimate in the midterm. All this stuff is turning from chemical to digital.
Yeah. Explain to people what the CRISPR is for people who don't know, because this is kind of mind-blowing for people. Just, can you explain it in a... like
on the spot. Okay.
Well, I mean, the CRISPR allows you to modify the
so
the
CRISPR
genetic,
is a protein,
yeah.
essentially, and then there's various different Cas9, Cas13, which enable you to reprogram genetic material.
Incredible.
Which is like, and it's a science which is like, been around the last couple of years. It's quite contentious because there's a whole kind of patent fight between kind of Berkeley and the Broad Institute, and it's but essentially the sort of the capabilities around that on the kind of near term allow you to perception to kind of change genetic makeup of materials, which is like transformational. And so it could...
Everybody's going to have beautiful blue eyes like us, Pete. Nobody's going to have brown or black eyes anymore. I mean, it's literally what it's going to be able to do at some point, right? People should be able to do...
Well, there's a lot of sort of ethical kind of stuff that will need to be figured out. But it's like, I mean, the amount of sort of genetic diseases and other things that could impact is like...
Yeah, no, can you imagine if you have like... I have a family member with cystic fibrosis, which is just, really serious disease, impacts a small number of people in a very big way. And most people don't live past 20, sadly. The same way some plagues and diseases we were able to eradicate, we might be able to eradicate genetic diseases or postpone them. Or
I mean, if you think back to like, people created sort of genetic variations by treating them to kind of radiation roses and like all those variation was kind of hit by sort of different chemicals and different radiation and created sort of different varieties that way. Like it's incredibly sort of cruel and primitive to do it that way. And this technology enables to do that in a whole range of different agriculture and obviously human biology and areas, which is completely remarkable.
It was pretty crazy. I went to Monsanto at one point. They had a couple of entrepreneurs and investors out, and I was like, most hated company in the world doing some of the most interesting things in the world. I got to check this out for myself. And it was quite interesting because they're like, well, here's what we're doing. We're making wheat with thicker husks. I'm like, why are you making thicker husks? Well, because you have these bugs that can eat the husk and then they wipe out the crop. So we just make a thicker crust and a shorter stalk, and now we've genetically, and it's like, that doesn't seem so bad to me. Like, is GMO bad necessarily, or is it good? I mean, people have I think a lot of these like lefty organic people are just immediately dismissing the concept of using science, but we were using science for hundreds of years to crossbreed animals and, make certain dog types and, make certain plant types by, fertilizing tall ones. Yeah.
But I think what we're seeing is that this is a change in Silicon Valley right now.
Oh, for sure.
So I think you look back over like 20, 30 years ago, and a lot of the, you go back to the kind of like Google days of like 2 Stanford PhDs with a patented algorithm was the hottest thing in Silicon Valley.
Right.
And then you go into like 2008, 2009, like post the sort of the smartphone launch, like 2 kind of design students with a really cool app.
Right.
And it would like exploding.
Change the world.
And now it's going back to that kind of like, it's
engineers.
It's engineer driven and it's hard tech. It's engineers not only are kind of building sort of very unique IP, but it's also surrounding themselves with thoughtful people to navigate whether it's regulated industries, whether it's tough go-to-market problems, whether it's tough scaling, manufacturing things they're trying to figure out. And it's a sort of weird time, as you know, the kind of like the sort of ocean front for investing is extremely wide with all these different kind of different kind of industries that it's impacting.
Yeah.
And the science behind it is incredibly deep and complex.
Yet we see in the New York Times story, like Silicon Valley's over, everybody's leaving, and that, with the exception of the real estate problem, I don't know if you saw the story in the New York Times, but they're like, oh my God, Peter Thiel's leaving, this person's leaving, it's over. And I just thought about it, I was like, feels like we're in the second inning or third inning to me. It does not feel like it's over. I mean, certainly San Francisco as a city is completely mismanaged and absolutely a disaster. And the Bay Area's real estate situation, as you know, being the CEO and founder of Trulia, like that's a disaster as well. But the creativity and the boldness of ideas here, I don't know if it's ever been at such a high level.
Yeah, I don't think it's certainly not over. I think that, we're obviously students of network effects. The network effect of Silicon Valley with this combination of capital, culture, and talent is breathtaking. And
it is unbelievable.
And it's like, while kind of there may be ideas and there may be scaling that happens outside of Silicon Valley, this is the best place in the world, certainly in the Western world, to start to build a world-changing company.
How do you think about valuation at the early stage? Do you look at deals and go, you're asking for $15 million, it's really an $8 million company? Or do you subscribe to listen, if it's a great company, 6, 8, 15, it doesn't matter? Because it's a question I get a lot by new angel investors. How do I know if the valuation's too high?
Well, we force ourselves to be we sort of, by our nature, pretty disciplined on valuations. I think we found that it's, obviously there's like a group of companies that have massively inflated valuations at the early stage, which creates downstream problems for them.
What are those downstream problems? If you have too high a valuation in the early stage, why would it create a problem in the later stage?
So, I mean, the big challenge is in terms of attracting further later stage investors. So clearly, if you're raising kind of like 6 million at a kind of like 20 million post as a seed round, unless you're able to make enough traction to raise the A at a kind of a high valuation, you're gonna face problems. So it's clearly they are. We subscribe very much to kind of a sense of small amounts of capital, early, modest valuations to help to scale the company.
Right. 6 to 10 million, that range seems normal in seed.
Yeah, in terms of seed. I mean, every company is different. There's some companies that require a little bit more capital to create proof points to get to the A.
Yeah. I'm in that situation with Cafe X right now, it's a hardware-driven company.
Right.
And real estate, there's like, there are a couple of factors here that you have to put a little more money in.
Yeah. But I think it's often quite easy to attract small angel investments via a note. And you can, raise with sort of credible entrepreneurs, raise substantial amounts of money. But then there's like no one really wants to step up to the A. Yeah. Because they haven't seen enough kind of traction.
Yeah. And they have too many choices, right? Like the Series A people seem to be looking at 25 companies in the last month that have $1 million to $2 million in ARR.
Yeah.
How do they pick?
Yeah.
They don't. They just wait to see which one hits 4.
Yeah.
That's a big problem, isn't it?
Yeah. It's a, part of our observation around raising the fund has been that, there is this sort of spectrum of choices between, whether it's the kind of like big seeds, small seeds, pre-seeds. A is like, in this area, there's clearly a kind of gap. There's both a gap of kind of people willing to step up and to invest and to support them, as well as a kind of a range of different choices where we can invest.
It's definitely, I think, the opportunity for folks like us to do these. I do $250 to $1 million checks. You do 1 to 2, but it just seems like everybody left this space. Everybody's like, I'll just go later and put more money to work, raise a bigger fund, get bigger fees. And it's like, that's not what these young, promising companies need. So I think it's our opportunity because they're missing the chance to own 10% or 15% of a company for a very small dollar amount when they're nascent.
Well, I think there's both for us, there's both the sort of, we think this is the gap in the market and the opportunity. But it's also like, we've been in companies at various different stages. This is the most interesting time in a company. The product market fit stage is the most interesting time. I
love that stage too. Why is it so fascinating to you?
It's clearly the most formative time. Yeah. It's like you've got this kind of founder product fit combined with this product market fit. Yeah. And it is it is when you start to see it happening, it's like lightning in a bottle. And it's incredibly nuanced and challenging to necessarily find that. And you see just like there's a founder I'm invested in, and he's texting me kind of like every 3 hours because there's some insight that he's had, and we
It's like
speak pretty
Zeus
much
throwing
daily.
a lightning bolt down. It's like,
Yeah.
by the way, the gods have just said yes.
And he's been working on this stuff for kind of months and months and months and months. And like in the last week, he's had 3 sort of transactions, and it's just this like you can see that this is like the energy and the kind of momentum is like he's got it. So he's in this groove, and he's like, okay, now I can like execute.
This was amazing.
And that's so formative.
It is. It was amazing to see with the jump bikes, which we were all sitting there for years watching electric bicycles in China. Also, Norway and Germany started to get the bug to a certain extent for these bicycles and electric bicycles. You saw it in Denmark. And I was just sitting there going, I wonder if Americans are going to go for this because they don't ride scooters, but in Europe, everybody's on a scooter, like an electric scooter. A motor scooter like a Vespa. You go to China, you see like 100 Vespas at a red light. It's crazy. And then 200 bikes behind them. And I was just wondering, when is this ever going to happen? And Scoot Networks here with the Vespas didn't really break out. It did okay.
Yeah.
But now for some reason, these bicycles, electric bicycles, seem to be winning the day.
Yeah.
When you look at that, what do you think the difference is? Why does one catch on and one doesn't? Is there some science there that or some insight you have as to when this lightning in a bottle happens?
So I think, typically we see it happening in the combination of 3 things. So one is technological, 2 is cultural, and the other is economic. So technology, so let's take these jump bikes, it's like, it's a combination of essentially mobile app, electric, and electric, enabling them to kind of provide this sort of mobility solution.
It's really the battery.
Yeah, the battery is kind of like in the
if it wasn't for phones, the batteries in Teslas and bikes wouldn't be so dense and amazing.
Technology breakthrough, kind of both on the consumer battery and the kind of e-bike. Yeah. Then there's cultural. I think there's like there's a sense that actually like cycling is like, hey, it's a pretty damn efficient way to get around, and like it's sort of good for the environment and it's pretty good for your health.
Yeah. So it feels good culturally.
And then the third is kind of economic in the sense that there is like, certainly I kind of biking around the city in the sense that there is, it's cheaper than kind of like stuck in traffic, and it's like it's about the same time. So I look for these like technology catalysts, societal catalysts, and economic catalysts. And when you get all 3 of them, like take Airbnb. This is like, technology, economics certainly kind of coming out of the kind of
I can rent a 2-bedroom for $200 a night instead of staying in a hotel with a 1-bed for $300 a night.
People
for 1-bedroom.
People want to save money as well as they want to make money out of there, and that's that sort of catalyst. Plus, there's a sense of trust of like the internet is like, okay,
more trustworthy.
I don't know who this stranger is, but there's enough kind of like.
That's the innovation that I think most people say. I think you hit it, Pete. Most people can't put their finger on that one because it doesn't exist as GPS or batteries. What that one is reputation systems. Yeah. So because everybody understood the Yelp reputation system or the Facebook one or follower accounts, whatever, or TripAdvisor, whatever, now they say, oh, well, if there's a rating system and reviews, which is a technological innovation and a cultural one, if 18 people have stayed here and given it 5 stars, and the one person who complained, the host replied and explained, hey, listen, here's what happened. The heater broke. It was my fault. We gave them a credit. They're still angry. Like, people understand that. Yeah.
And that cultural breakthrough is like, you see like old school investors like, well, that's never going to work. But then you speak to kind of like millennial users and like,
Obviously.
I trust that way more than some sort of
they're like
travel guide in the kind of bookshop.
It's exactly right. They're like, why would I trust some hotel for my safety? I mean, I'd much rather trust this person who owns the home who's letting me sleep on their guest house. It's much safer than a hotel.
And these, when you think about these catalysts, certainly cultural and technological, they're moving so fast right now. So that, clearly that creates the opportunity.
You feel old now, like where your thoughts as a Generation X person like myself, that our thoughts get in the way of our ability to invest in this new crop of ideas. Do you feel that sometimes? You have an example where you said, like, I would never do this. I would never Snapchat myself all day long and make 50 videos. But I understand that millennials grew up with cameras and phones and they have a different idea about socialization. So they would make 50 videos a day. I'm not a narcissist maniac. I'm not going to do that. Do you find yourself hitting those moments?
I certainly did. Like, I was like laser focused on like running a public company. And like you have a set, you become conditioned in that environment to actually like, okay, I know this kind of vertical extremely well, and this is the business model, and and I cannot deviate from this. And so, and then I think I've kind of had to reprogram my brain.
Yes.
From kind of being this sort of like deep kind of industry, sort of an operational expert, into this broad kind of cultural and technology expert, and covering all these things. And you end up kind of being a lot more sort of prepared and open-minded around stuff in a way that you kind of perhaps wouldn't be. And I think you become, I used to be more dismissive of this sort of like of these things than I am today, because you realize that, it's not about kind of necessarily what you would do as an individual, but you actually like, if this was to happen, then I can believe that will be a very big thing.
I tell people you have to unlearn what you have learned. You must unlearn what you've learned, because it may not apply anymore. And just because you wouldn't stay in an Airbnb and you wouldn't rent out your guest house as a 50-year-old or a 40-year-old, that does not mean that a 20-year-old who could never afford to go to Japan or Paris is not going to take the opportunity to go there for the first time and stay there for 10 days for the price it would have cost to go to Florida. They want to be more adventurous, and it's an easy, like, I'll stay on somebody's couch for $50, $60 or in their guest bedroom rather than not go to Paris. It's an easy decision for a young person to make, but you would never see that. I would never see that, because why would you try to save $100 and stay on a serial killer's bed in their house, right? Like, it makes no sense to us.
I think it's, so that it's changing different, particularly kind of financial services, healthcare, kind of, real estate industries, where you kind of have these preconceived notions around, okay, of course you need a mortgage to do that. It's like, well, maybe you don't.
Or of course I need to have health insurance, or maybe reallocate that. But so then I will take it that you're buying every ICO you can, because you don't want to be so close-minded and stuck in your ways that you're buying tokens and Chuck E. Cheese tokens instead of equity. These 8 deals you've done are all ICOs, or
we've invested in some crypto stuff.
An ICO or equity in the company?
These ones, it's a sort of mixture. So it's we don't sort of have any. I mean, the good thing about a new fund is that we kind of like we saw the ICO thing coming, and we were able to structure ourselves.
What did you think of that ICO stuff? When you see these tokens and people raising $10 million with no product?
Yeah, I mean, clearly there is like this sort of, there is some concern around it, but and there is a huge amount of very, very, just like low quality. These are opportunistic entrepreneurs who are trying to kind of, raise money from people because they can, not because those people should invest. So there's a lot of,
concerns.
It's a wild west and a lot of cowboys out there. So, but that said, there are a few highly legitimate and very credible ICOs out there that we think, which we think are kind of interesting. So,
do you think you could actually stomach buying tokens and not equity as an investor?
Yeah.
You could.
Yeah.
I can't stomach it.
It's not our preferred, but it's like, I think it's.
I would need to see the token in use for 6 months or a year before I would ever want to buy tokens with no protective provisions, no equity. It makes no sense to me that a large venture, I heard there's rumors that large venture capital firms were buying the Telegram ICO. And I was like, how can you take a retirement or an endowment's money and buy tokens that are not even being used in the world and not own equity, have no protective provisions? To me, seems very troubling.
Well, here we are. This is your old school kind of point of view on these things, which is like, and I think there is, I do believe that the blockchain and cryptocurrencies have the potential to dramatically change our financial systems. And it's like, I was speaking at Stanford the other day and like asking them what the students are kind of into. And unsurprisingly, crypto, blockchain, in the same way that you and I grew up and like the internet, and we could like program HTML. Like it was just like,
and people told us internet would never be anything.
Yeah, it was native to kind of us, and I think the native language, certainly in the computer science departments, is around blockchain.
The only difference was, I think, in that era, we knew what we were using. Like you said, we could code HTML pages. We were using HTML editors. And I see these people doing crypto and they don't understand the underlying asset, what they're buying, who they're buying it from.
Well, that's the investor club. The investors are like looking at that, but I think the wave of talent coming in is remarkable.
Phenomenal. Yeah.
It is absolutely remarkable. And what's happening right now is that the kind of the value of the aggregate value of some of the projects is kind of up here in terms of financial value.
Yeah.
But the kind of like economic value creation is down here.
Yeah, 1%.
And we've seen this before, right?
Yeah.
In the internet. And so the same thing kind of happened. But it's like...
It's got to flip.
Well, so one of two things will happen. Like either the value is created or catch up to the economic value in the ecosystem, or the prices will come down.
Prices have come down 50%, 90%. 90% in ICOs, 50% in crypto.
Yeah,
so maybe we're soaking in it right now.
But I think, long term, I'm a big believer, and I think it will come in a sort of perhaps the less obvious ways, a little bit like it did in the internet.
Yeah. Like who would have guessed Amazon would have been the winner? It's like the guy selling books, that's the winner? That's the guy who built the cloud computing infrastructure?
Well, well, I don't know. You know,
like who saw that coming?
Certainly the cloud infrastructure, you couldn't see that coming.
No.
But certainly the kind of biggest retailer, maybe you could. It was
maybe.
Like...
it was a little like, he's really going to compete with Walmart. It was like, yeah, shipping's too expensive.
Yeah, but it's time and time again.
Yeah.
The incumbents basically, get overturned by the emerging. I think it's what is sort of interesting is also around the globalization of this. Like, we spend like we kind of like the nature of our partnership. We have one Brit, one Israeli, and one American, and so we're like naturally kind of like tuned to take the best of Silicon Valley, but also kind of expose ourselves to global thinking. And it's we think often a lot of the most interesting innovations that are happening in the blockchain are happening outside the US, and it's going to be fascinating what happens in regulation in the SEC with related. Does this kind of create a fertile environment for this innovation? Is clearly a massive opportunity of innovation, or does it diminish it and it spreads into other parts of the world?
This to me seems like this is the real conundrum we're in. There's obviously these ICOs, or the majority of them, are incompetent and or frauds, just by the fact that one study said 60% of them have gone dark in only 12 months.
Yeah.
Like funded startups don't go dark in 12 months. It may take them 2 or 3 years to go dark, but 60% don't go dark in the first year. So there is a massive amount of fraud and an even larger amount of incompetence. I think even people who are the biggest crypto heads agree in the ICO space. So clearly there's fraud and the SEC needs to protect people. But there's clearly a massive opportunity for distributed systems to have a financial incentive like this is incredible.
Absolutely incredible.
So if we enforce the rules, we drive them to places that are unregulated. There's unregulated people, whether it's Puerto Rico is now going to have a crypto. Brock Pierce is building some crypto nirvana. And then I think Taiwan is building one. There's Zug in Switzerland. Yeah. And Peter Thiel is going to build an island, and there's going to be all these places where we can go and not pay taxes or not check if somebody's an accredited investor.
Yeah, I mean, I think for really to create economic value, it has to be sort of supported by, governments in kind of meaningful ways. Otherwise, it's just there's not going to be enough economic value. It will become the kind of like, it won't be adopted. It won't be, part of the currency or infrastructure. But it's I think it's basically, it's out now. Yeah. It's a little bit like, it is the genie's out of the bottle, so to speak. The technology cannot be disinvented.
No.
And so
it can be regulated.
It can be regulated, and it can be kind of
illegal.
It can be made.
China
I don't know
will.
If that's a solution to it.
It's not a solution, but it is what people in China do. I mean, they ban VPNs and they ban Twitter and Facebook, so it can happen.
It certainly can happen. But I think I'm very bullish on it as a kind of as a technology and infrastructure. It's like it's going to be the Wild West for a little bit, certainly a few more years. But you're starting to see highly credible entrepreneurs, highly technical founders get involved. Executives are kind of like in this ecosystem, and you're starting to see what Silicon Valley does best, which is the kind of innovation plus the execution come in to build these ultimately world-changing organizations.
All right, let's recap. It's been 75 minutes with Pete Flint from NFX Guild. And by the way, if you didn't know, that stands for Network Effects. You can visit them at NFXcom, a 3-letter domain name. Wow, you guys definitely, that's not cheap.
Early.
You got early. NFX.com. And what did we learn today? They write $1 to $2 million checks, reasonable valuations. They like to price the rounds. They look for founders who are resilient and won't give up, indefatigable. And believes in crypto and survived 2 unbelievable crashes and built during the down market. I think that's such an important part because the market, we're in the second longest bull market, I think, since World War II.
It's going to happen. It's going to be great for entrepreneurs.
Fantastic for entrepreneurs. Then there won't be as many companies. And getting a meeting with guys like us won't be as hard. And gals. Like, it's going to be easier to get meetings, easier to get capital. The valuations go down, but the opportunity will go up.
Absolutely.
Build in a down market. All my great investments. Down market. Google, Facebook, Uber, built in down markets.
The opportunity.
Exactly. All right. Thanks for coming on the program, Pete. It's
my pleasure.
It's been too long. We haven't seen each other in a while. Congrats. And I'll look forward to getting the next 8 deals. I'm always looking to get a little piece of that.
All right.
I need to get a little piece of that cap too. I got to save J-Cal a little slicey poo. All right, everybody. Thank you, Emmy Award-winning producer Jackie. And thanks to everybody for supporting season 2 of Angel the Podcast. It really helps if you go to iTunes and write a review because my mom reads every one. You can then tweet that review to me, take a screenshot, tweet it to me at Jason, and I will retweet you and give you a thumbs up and a fist bump. Go ahead and write a review on iTunes and follow us, et cetera, yada, yada. Angelpodcast.com. And if you haven't read the book already, please go buy the book. It's a great deal, if I do say so. Books are ridiculous. $16, $10. You get all this knowledge. And if you want to angel invest, or at least see what I'm angel investing in, read the book first. Make small bets. That's always the advice I have. Year 1, no rush. Make small bets on a lot of companies. Don't spend more than 10% of your chip stack in year 1. Learn. Right? You weren't writing $1 million checks the first year, right? 25, 50, 100K.
25K. Yeah. Scale from there.
Scale from there. Take your time. It's no rush. Learn. It's the third inning. As far as I'm concerned, we're in the 4th inning of Silicon Valley. The best is yet to come, I think.
I think so.
All right. On that note, thank you again, Pete Flint. Follow him, Pete Flint, on Twitter. And if you're doing a network effect-driven business, this is the person you want on your team. NFX.com. We'll see you all next time on Angel the Podcast. Bye-bye.